37, provisions, contingent liability and contingent asset. Assuming now you have a liability and you do know that liability you are required to pay money to other people, and you are not sure whether the payment of money or the likelihood of payment is high or low. So in front of you, this particular level of liability is actually indicating the likelihood that you are going to pay the money. In real world, the liability, there's a gray area. It's not just about no liability or with liability, but it can be ranging from 0% to 100%. So there are multiple layers of liability that you can see in here. Just now I mentioned no liability, meaning to say completely you don't have any obligations. But 100% liability, meaning to say this is confirm your liability and you need to pay money. For example, I buy goods from other people. I get the goods. In return, I need to pay money. This is so-called the present obligation. I have no practically ability to avoid, something that mentioned in conceptual framework. And this present obligation will result in transfer of economic resources, meaning to say I need to use my asset to pay my liability. Therefore, it is my liability. And to recognize it, probable FEB, outflow, and measured reliable. And the FEB level normally is virtually certain or probable, and we just record in S or FP. This is what we learn in our those days very simple accounting subject. We just debit expenses increase, and credit our liability. But actually in real world, right, it's not just liability or no liability. There could be something called as provisions or something called as contingent liability. So provisions, meaning to say that if you look at the level of liability, is the second serious liability where you have a probable outflow. Probable meaning to say something that is more than 50% until 99%. Meaning to say something that is still under the gray area. So in this case, right, we will call this as a present obligations from the past event. Of course, you must have do something bad in the past, therefore you have a present obligation now. Or you must have doing something now that make other people think that you have an obligation now. And these obligations is uncertainty in timing and uncertainty in amount, meaning to say you don't know when is the exact date to pay this money, or when is the amount, what is the exact amount of paying this money. Could be entering into the lawsuit case if you get sued by other people, for example. So this lawsuit case, whether you win or you lost, will depending on the court judgment. And depending on the court judgment, meaning to say is uncertainty in timing. And some more, you don't know what is the amount, exact amount, but you can estimate based on the lawyer advice. So this is actually known as a provision or present obligation. A provisions, you look at the actions, we must record in our S or FP as a liability. So to consistent with prudent concept, because we always don't want to understate our liability or understate our expenses, we will record something that is probable, quite certain will happen, but not yet reaching 100%. We will record it in our S or FP, provided it must be probable outflow and measured reliable. Meaning to say, if today lawyer tells you most probably 60% you are going to lose the case, so this is probable outflow, and lawyer able to give you an estimated amount, or you can derive an estimated value. This is a provisions, and the provision can be give rise from two situations. One is legal, like what I tell you just now. You are owing to someone because you are breaching the law. You breach of contract, people eat your food, then they food poisoning, they sue over you. Employees sue you because you are not an ethics employer. All that because you are breaching the law and regulations, then this is a legal obligation. So meaning to say these legal obligations can be further classified into legal and constructive. Constructive meaning to say you are not against any law, meaning to say you comply with the law, but because of past practice or experience or expectations, people expect you to do like that. For example, sales return. If let's say you have an experience that over the years, the customer will return about 5% of your sales as the sales return. Meaning to say, you record 100K this year, okay, 100K this year, but there are 5% always come back in the following year to ask for refund. So this is called, based on the past practice, you understand that that kind of trend is happening in your business and you record this liability in your business. I give you one example is the provisions for sales return. So this sales return you didn't actually against any law, because based on the past practice people do, you also know, then please, this is a constructive obligation. By past practice, expectations, people ask you, you must record. Certain warranty that is not required by law also can be argued as constructive obligations. Therefore, something that is not against law, but you know that it is a present obligations because by practice, by experience, you are owing to other people or you have the liability, then please record. This is your provisions. So this is kind of like principle based. You need to think about it. And must be probable outflow and measured reliable. There are one example that we are going to look into it is on the provision for restructuring. Restructuring meaning to say today, if you want to retrench your staff, meaning to say your business is not doing good, you want to close off certain divisions or subsidiary, some stuff you need to compensate them or you need to relocate them, give them training or whatever. Okay, so all this require cost. So question, can we record that cost now because we know that we are going to happen in future, we have a liability to do that? Are we going to record it in our SOFP as a liability provision? The answer is certain thing, yes. So this is called constructive obligation. You didn't against any law, just that you want to restructure, reorg your company. Therefore, you have these obligations. So provisions, we have closed, and this is probable. We go one more layer lower, contingent liability. Contingent liability, you see the outflow is possible. Possible meaning to say 50% or lower. Okay, not reaching 0%. 0% meaning to say is no liability. So 50% or lower, meaning to say in this case, you have the liability, but then the happen rate or the likelihood to happen is not very high. It's 50%. Like I tell you, later it's going to rain 50%. So meaning to say 50% is going to rain, 50% is not going to rain. This liability or these things, something that there is a chances but not high. Not as high as significant like provisions. So this contingent liability, there are two definitions. As you see over here, there are two definitions. One is possible obligations. Present obligations. So present obligation is the extensions of this part. If it is a present obligations, originally is a provisions, but if you know that it's not probable outflow, and or not measured reliable. So originally, it is your provisions, present obligations, probable outflow, and measured reliable. If you know that this probable outflow and measured reliable, either one cannot demonstrate, if not meet, then we are going to call it as your contingent liability. I give you one example, very typical example. You breach of contract with your customer sue you. After the year end or during the year end, lawyer tells you, most probably you are going to win the case. You are going to win the case means what? You are less probable or not probable for the outflow of future economic benefit. Meaning to say you will win the case, you will save the money. So even though you breach the contract, there's a present obligations, but the outflow is not probable, this liability will call as contingent liability because present obligation, not probable outflow or not measured reliable. But however, if let's say I change the scenario, become you breach the contract, lawyer advise you, most probable you are going to pay the money. Then this will go up, become your provisions already. So this is trick between provisions or contingent liability under these definitions. Another definition is possible obligations. Possible obligation meaning to say something that might happen is not present obligation, it's a possible obligation confirmed by occurrence or non-occurrence of future event and not wholly entities control. I give you a very simple example, guarantee. If let's say your parent company, so this parent company is behind the subsidiary, and the subsidiary is actually signing a loan contract with the bank to borrow money. And the bank said, hey subsi, I'm not so confident with your financial situations. Can you ask someone to become your guarantor? Definitely it's the parent. So parent will become the guarantor to guarantee that subsi will always performing well to pay bank. So parent actually don't have a present obligation. These present obligations will depend on certain things. Meaning to say, in order for the parents to have this present obligation from the case of guarantee, parent obligations will depend on certain future event that is occurrence or non-occurrence. If subsidiary cannot pay, then ultimately who is going to pay? Parent. So these present obligations will depend on whether subsi can pay or cannot pay. If cannot pay, then parent has to be paid, become parent's present obligations. If not, this is still parent possible obligations. Meaning to say 50-50% lah, depend on subsi. So this example is guarantor, meaning to say they are not directly signed with bank, it's subsi, but in the middle, depends on certain things, this possible obligation will become present obligation. Normally, we will just disclose it in notes to FS. Not normally. Confirm as contingent liability, we must disclose. We just let other people know that, hey, I have this contingent liability, something that might happen, but at the moment not happen yet. So to preempt that particular users that this one might be happen. So please take note. So that will be depends on the users how they interpret. If the financial situation is not good, look at the subsidy is not good, this contingent liability can become a present obligations, and this will move up to a provision, which will distort the financial statement. This is how we read the entire chart for the liability. And the most simplest one, no liability means remote. Remote means totally you're not going to pay anything and no actions. So this is the overview of your liability, provision, and contingent liability, where the first two part of IAS 37 is actually focusing on these two. And the last part will be contingent asset. So the contingent asset, as you can see, is the opposite of contingent liability. These definitions is a possible asset from the past event confirmed by occurrence or non-occurrence of future event, not entities can control. Okay, this is like, for example, you claim insurance claim. A fire happens and logically you are going to claim from insurance. So if let's say insurance company say, okay, I'm going to compensate you money, this is called probable. If contingent asset with probable future economic benefit, contingent asset with probable future economic benefit, we only can disclose in financial statement. We only can disclose in financial statement. Only when it is virtually certain, meaning to say the company bank, the insurance company not only call you, they also send you the legal letters or check. Then it is virtually certain, meaning to say they already black and white, put everything black and white that you will get this asset. Then virtually certain you can record. If it is still probable, meaning to say most likely you are going to get, then we still disclose. Can you see the difference? For provisions, probable outflow, we will already record in SOFP. But for contingent asset, even it is probable inflow of future economic benefit, we still disclose because this is in line with prudent concept. We don't want to overstate our asset. Good things not confirmed yet, I don't want to record. If good things probable only, I don't want to record. Only confirm, I record. Therefore, contingent liability is something to be disclosed if probable inflow. So this is the overview of IAS 37. And now let's look at the specific areas. So first, provision for restructuring. Just now I mentioned some company, maybe they're going to undergo with reorganizations or restructuring. So this restructuring require money to spend. They will need to plan and see which fella is going to transfer to that department or which fella is going to transfer back to any department. So this is called reorg. So when they do reorg or restructuring, they cannot just put, okay, I'm going to do restructuring, then let's put in provisions. Cannot be like that. Because some other people's, they are not in a serious restructuring. Maybe they will just debit expenses, credit liability this year. Then next year, oh, I don't want to do restructuring already. You reverse. Your expenses will go back to next year. Your expenses reduced will go into next year. So in this case, you are like doing a, window dressing of account already. Because if you record expenses now, you don't want to use it, you are going to reverse next year. If you reverse, become your income already. They are like overstate the profit already. So this is called window dressing the account. So in this case, provisions for restructuring expenses, IAS 37 require them to record it when you have a detailed plan. So we need to go and check the clients whether they have detailed plans on hand. And all this detailed plan has raised valid expectations to those who are affected. Not just to have a detailed plan. You must also have the actions to send it across to the people that affected from this case, like the employee, customer, supplier, everyone that is going to impact from this restructuring. They are aware and they are knowing that things will happen. Then shows your seriousness, only you can record this restructuring. So remember, restructuring most important two criteria is these two additional criteria. And another one is onerous contract. This onerous contract is actually contract that you are unable to avoid, unavoidable costs, that associated with unavoidable costs to meeting the obligations when your contract is actually exceeding economic benefit to be received. So in this case, you will need to record provisions of this onerous contract if you have a present obligation. What does it mean? If today you have a shop lot, example, and over this shop lot, you are required to pay, you are signing for 3 years. You're signing for 3 years. If this shop lot, you are going to sign in for 3 years, every years, you are going to pay 100k. If you terminate, you are going to pay 250k. Okay lah, too high. Maybe 170k. If you terminate, you are going to pay 170k. So if you didn't terminate, 100k per year. So in year 2, you decided you don't want to continue use this shop lot already because this shop lot don't have people. That traffic is disaster. No traffic, no sales. So the contract obligation is exceeded the economic benefit already, and this is an onerous contract. So in this case, in 2 years, in year 2 beginning, you decide whether I want to continue. Option 1, continue. Continue meaning to say what? Continue means cost of fulfilling. You continue fulfilling the asset and fulfilling the liability. So in this case, you continue fulfill is 200. If you compensate, then 170. So in this case, if you are the owner, it is makes sense to choose the lowest one. Therefore, IAS 37 onerous contract also tells you when you want to recognize these onerous contract provisions, we are going to record the lowest between the cost of fulfilling or compensate it, because this is what the business owner will do, and this is the valuations. And the third one, or the last one, specific area will be the future operating losses. IAS 37 specifically prohibited any business to recognize any future losses at now, because this is something that doesn't make sense. We are doing financial reporting based on past event, not future event. So that's all on IAS 37. I hope you learned something. Thank you.